A catastrophic 5.35% drop just completely wiped out the KOSPI index. It was swift, it was brutal, and honestly, it left the entire market reeling. Welcome to today's explainer. KOSPI plunges 5.35%, Iran escalation meets a chip-concentrated index. We've got a lot of ground to cover today, and we're going to move fast. Our focus here is strictly analytical. We are going to peel back the layers of this crash to separate the geopolitical noise from the actual underlying market mechanics that dictated the sheer size and reach of this massive decline. The magnitude of this drop is just staggering. We're looking at a close of 7,246.79. And to put that into perspective, this isn't just a minor blip. This marks the index's third straight brutal decline. We're talking about a massive liquidation event that erased incredible amounts of market value in a matter of hours. And the bleeding was literally everywhere. A staggering 81% of the market, that's 765 out of KOSPI's 945 listed stocks, closed lower. Only 125 managed to eke out a gain. The selling pressure wasn't isolated at all. It infected almost every single corner of the market. Just look at this intraday cliff. The market didn't just dip, the floor completely gave out. But here's the thing. A crash like this doesn't just happen in a vacuum. To understand this chain reaction, we have to look at why the market was a powder keg well before the geopolitical spark ever hit the wires. Let's start with Section 1, Memory Chip Giants, Vulnerable Foundation. Even before any external shocks hit, the two heavyweights, Samsung Electronics and SK Hynix, were already staggering. In the days leading up to the crash, both of these giants were facing severe structural warnings. The market was already second-guessing their near-term prospects, leaving them incredibly exposed to any downward pressure. For SK Hynix, the heat started with a massive NASDAQ depository receipt offering. They started book building for a deal sized at around 45 trillion Korean won. That's roughly 29 billion US dollars, or about 2.5% of their total outstanding shares. Korean investors immediately read this as a massive dilution risk, which naturally spooked the market and drove the stock down in the preceding sessions. Compounding that anxiety was a highly critical downgrade warning from Morgan Stanley. They explicitly recommended cutting exposure to memory chip stocks, calling out Samsung, SK Hynix, and Micron by name. Their core argument was actually pretty surprising. They believed memory chip earnings momentum had already passed its peak, advising investors to pivot toward AI hyperscalers instead. And here's where it gets really interesting. Samsung's preliminary earnings kind of confirmed Morgan Stanley's fears. They reported a massive 89.4 trillion won operating profit. But the catch is that this profit was driven almost entirely by price hikes. DRAM contract prices were up roughly 60%, and NAND was up over 70%. But actual shipment volume growth, basically flat. That price-driven structure was exactly what analysts were warning about. Moving right into Section 2, the geopolitical spark, igniting the sell-off. So with the chip sector already extremely vulnerable, all it took was one external shock to light the match. Going into Wednesday's session, the KOSPI actually opened lower, but surprisingly it tried to stabilize. During the morning session, investors stepped in to buy the semiconductor dip at lower prices. For a moment, the Yoido Financial District thought the absolute worst might be over. Well, that morning recovery violently reversed right after 1 p.m. Breaking news of expanding U.S. airstrikes on Iranian targets flooded the trading floors, immediately followed by confirmation that Iran had struck roughly 80 U.S. military facilities in Kuwait and Bahrain. Geopolitical risk instantly spiked, taking oil prices and bond yields with it, and market sentiment completely collapsed. The reaction in the futures market was instantaneous. Let's walk through the timeline. At 1:31 p.m., KOSPI 200 futures plummeted over 5%. That triggered a sidecar, a temporary trading halt designed to pause program sell orders and stop the panic. But just 2 minutes later, at 1:33 p.m., KOSDAQ futures fell 6.31%, triggering a matching sidecar. The panic was totally systematic and overwhelming. Which brings us to Section 3, Index Concentration, the KOSPI trap. But why was the drop so exceptionally severe? We have to look at the structural mechanics that turned a bad news day into an uncontrollable flash crash. The KSOP has a fatal flaw. Over 54% of the entire index's market cap is tied up in just two stocks, Samsung Electronics and SK Hynix. When these two heavyweights fall, they drag the entire market down with them. With Samsung down over 6% and SK Hynix down nearly 6%, those two stocks alone accounted for more than half of the total index decline. And algorithms made this structural trap so much worse. Trust accounts operate leveraged ETFs that track these giant chip stocks. When the underlying stock price falls, the leveraged ETF is mathematically forced to sell the stock to maintain its daily fixed leverage ratio. It's a vicious cycle of algorithmic forced selling that rapidly amplifies volatility for the broader index. To really grasp the scale of this forced selling, check out this staggering number. Trust accounts dumped an incredible 386.2 billion won worth of SK Hynix shares in a single day. That accounted for 93% of all trust account selling on Wednesday. It was just a pure mechanical, emotionless liquidation. Let's pivot to Section 4, Foreign Buying Signals, Hidden Truths. If we look a little closer at the data, a fascinating counter-narrative pops up about what the smart money was actually doing while everyone else was panicking. While domestic trust accounts were forced selling, foreign investors were actually net buyers of the KOSPI for the first time in 14 trading sessions. And they were highly targeted. They aggressively acquired AI supply chain assets, scooping up 166.2 billion won of SK Hynix, 157.6 billion of Samsung Electromechanics, and 109.4 billion of LG Innotek. They were literally using the crash to buy high-bandwidth memory and AI infrastructure at a massive discount. However, we have to contrast that targeted buying spree with this massive figure. Foreign investors executed a huge liquidation of Samsung Electronics, selling off 874.1 billion won net. This single action accounted for 68% of all foreign net selling across the entire KOSPI, which dragged the headline foreign flow number way down, even though they were heavily accumulating other AI-linked tech stocks. So the crucial takeaway here is this glaring divergence. On the exact same asset, SK Hynix, you've got two completely opposite behaviors. Algorithmic trust accounts are forced into being massive net sellers due to ETF mechanics, while foreign investors are stepping right in as massive net buyers, happily accumulating the stock. With algorithms forcing massive sell-offs on one hand and foreign capital quietly hoarding AI infrastructure assets on the other, it leaves us with a huge question. What is the true state of the memory chip cycle? Is the algorithmic panic just masking the real underlying demand for AI? If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.